Right now, we are short 46.3 million ounces of silver globally. And at the exact same time, it's April 2026, right? 25% of the world's seaborne oil is effectively blocked in the Middle East.
Yeah, it's a massive disruption.
Right. So if you look at any historical playbook, the prices of gold and silver should be violently exploding. But today, I mean, they're practically yawning. Gold is just sort of hovering, and silver is stubbornly flat.
It really defies every basic instinct of economics. I mean, you have this acute, undeniable physical shortage colliding with a massive geopolitical crisis, and yet the market mechanism that is supposed to, sound the alarm is completely silent.
And that impossible contradiction is exactly what we are tearing into for this deep dive. So we are looking at a brilliantly detailed analysis by Doug Young. It's called Iran Tensions, Gold, Silver's Impending Response.
It's a great piece.
It really is. Doug brings over 2 decades of financial market experience to the Gold IRA Company's bulletin. He was actually a financial director for 16 years, so he understands the actual plumbing of global logistics and pricing.
Yeah, but before we look at that plumbing, we need to frame the reality on the ground. The analysis centers on the cascading effects of the late February 2026 attacks by the U.S. and Israel on Iran and Iran's subsequent blockade of the Strait of Hormuz.
Right. And we should pause here for a second.
Yes, absolutely. We must be absolutely clear to you, the listener, right at the start. This deep dive takes absolutely no political sides regarding these highly charged events.
None at all.
We are not endorsing any viewpoints, military actions, or state policies here. Our sole purpose is to impartially break down the factual economic data and market reaction.
Exactly. We're just here to uncover the hidden mechanics actively suppressing precious metal prices right now. And, to figure out what triggers could shatter this illusion of stability.
Because it is an illusion.
It really is.
Yeah.
Looking at commodity prices right now, it kind of feels like looking at the ocean from the beach. The surface looks completely calm, but beneath that placid water, there is this massive, dangerous undertow pulling in the opposite direction.
That's a great way to put it. And to measure the force of that undertow, you have to look at the sheer physics of the Strait of Hormuz crisis. This isn't just a minor detour.
Right.
That strait is a non-negotiable choke point handling a quarter of all global seaborne oil trade. With both Iranian and U.S. naval presence obstructing traffic since late February, well, the logistics network hasn't just slowed down. In many sectors, it has literally hit a brick wall.
And the immediate reaction to that makes sense, right? Energy prices spike.
Yeah.
But the analysis maps out how this bleeds into everything else almost instantly.
That's a total cascade.
Yeah, like when oil gets constrained, natural gas experiences wild volatility. And natural gas isn't just for heating your house. It's the foundational chemical input for creating industrial fertilizer.
Which is wild to think about, because it means a shipping conflict in the Middle East dictates the cost of growing a field of wheat in the Midwest.
Wow, yeah.
The natural gas goes up, fertilizer production costs soar, and food prices are dragged right up with them. Then you factor in plastics, manufacturing, and the raw cost of rerouting container ships thousands of extra miles.
Because they have to go all the way around Africa now.
Exactly. Every single industry is absorbing vastly higher input costs right now.
So what does this all mean? If fertilizer, food, shipping, and raw energy are all exploding in cost, shouldn't the rational move for any investor be to panic buy gold and silver?
You would think so, yeah.
Right? They're the ultimate historical safe havens. If the world is burning, you buy the fireproof assets. But they aren't. As of right now, April 2026, gold is just casually consolidating around the $4,700 to $4,800 range.
Which is high, but not a panic spike.
Exactly. And silver is lingering around $75 to $80 per ounce. Why aren't investors panicking into metals? Why isn't there widespread panic buying?
Well, it's because the modern financial system has built-in mechanisms that actively suppress that ancient instinct to hoard physical metal. In the short term, you have a resilient U.S. dollar and, crucially, severe liquidity drains.
Hold on, let me stop you there. What does a liquidity drain actually mean in this context? Why would an institution sell their safe haven silver just because the broader market is getting tight?
Okay, think of liquidity as the cash moving through the pipes of the financial system.
Okay.
When a geopolitical shock hits, credit tightens up. Banks and large institutions suddenly face margin calls, which are basically demands to put up more cash to cover their highly leveraged trades and other struggling markets.
Ah, I see.
Right, so if you are an institution and you urgently need millions of dollars in cash today, you don't sell the assets that are crashing. You take a massive loss.
Right, you'd be selling at the bottom.
Exactly. You sell your highly liquid assets that are still holding their value. Often that means dumping huge amounts of paper, gold, and silver onto the market just to raise cash, which artificially drives the overall price down.
Okay, so the panic actually forces them to sell the exact thing they should be keeping. That's wild. But what about the stock market? Equity indices seem to be ignoring these compounding global risks, too.
That really comes down to the sheer volume of algorithmic trading. I mean, these algorithms aren't reading geopolitical think pieces. They are programmed to react to immediate microscopic data points.
Like earnings reports.
Exactly. If a major tech company releases a positive quarterly earnings report, the algorithms instantly buy in, keeping the equity indices artificially buoyant. They are trading the immediate numbers of today, completely ignoring the structural supply chain reality of tomorrow.
That makes sense.
But look, the absolute heaviest weight keeping gold and silver prices contained is the paper market itself.
Let's get into the mechanics of that. When we see the price of silver ticking across the screen, we aren't actually looking at physical bars of metal changing hands, are we?
Almost never. You are looking at the paper market, futures contracts, derivatives, exchange-traded funds.
Right.
These contracts were originally designed so a miner could lock in a price for their metal before they even pulled it out of the ground. But today, the volume of paper trading dwarfs the available physical metal by massive multiples.
Like, you can trade millions of ounces of paper silver in a microsecond.
Exactly. It is entirely digital accounting.
So is the paper market basically acting like a shock absorber on a car that just hit a massive pothole? You don't feel the jolt in the passenger cabin yet, but the actual physical suspension underneath is taking massive, invisible damage?
What's fascinating here is that your analogy maps perfectly to the inventory data, because to keep that shock absorber functioning, the system requires physical buffers.
Right, because eventually someone holding a paper contract is going to demand the actual metal.
Yes. So to delay the price signals from reaching the paper markets and causing a panic, the global physical inventories of oil, gold, and silver are being quietly drawn down to satisfy that immediate demand.
But wait, if the smartest players know this shock absorber is taking damage, why aren't they breaking the system? The analysis mentions central banks have been hoarding billions in physical gold since 2022 to protect themselves against historic government debt and inflation.
They have been, yeah.
So if central banks are secretly hoarding physical gold at record levels, why isn't that massive buying pressure driving up the spot price?
Because central banks are remarkably disciplined buyers. They don't just log on to an exchange and dump $1 billion into market orders, which would immediately spike the price.
Oh, right, that would cause chaos.
Exactly. They execute what are called over-the-counter trades. They buy directly from miners or sovereign vaults in private off-exchange transactions. This keeps their massive accumulation largely hidden from the daily paper price algorithms. Yeah, they are quietly filling their lifeboats without sounding the alarm on the ship.
That is a brilliant and kind of terrifying strategy, and it brings us directly to silver, because gold is primarily a monetary metal. I mean, mostly just sits in vaults.
Right.
But silver has this dual identity. It is money, but it is also a highly consumed industrial metal. And silver is currently facing a supply chain nightmare that the paper markets are entirely blind to.
Oh, completely blind.
We are looking at a projected deficit of 46.3 million ounces for 2026 alone. That is a 15% widening of a deficit that has now been running for 6 consecutive years.
Think about what that actually means. We are fundamentally consuming more physical silver than the Earth is currently giving us, and you can't solve this with a simple pricing mechanism.
What do you mean?
Normally, if a commodity is in short supply, the price rises, which incentivizes companies to build more factories or, plant more crops.
Right. So if we need 46 million more ounces, why don't mining companies just open more silver mines to capture that demand?
Because primary silver mines like operations designed specifically to extract silver, they hardly exist. The vast majority of the world's silver is pulled out of the ground as a byproduct.
A byproduct of what?
Base industrial metals. It happens when companies are mining primarily for copper, lead, and zinc.
Oh, I see. It's like a lumber mill, right? You are chopping down thousands of trees for the wood, which represents the copper.
Yeah, exactly.
And the sawdust left over on the floor, well, that's the silver. If the market suddenly demands a massive amount of sawdust, you aren't going to chop down a million extra trees just to sweep up the floor. It doesn't make economic sense.
That captures the inelasticity of it perfectly. The copper miner operates on the multi-billion-dollar economics of copper. They don't really care about a slight bump in the price of byproduct silver.
Right.
So primary mine output remains stagnant, completely unable to respond to price signals. Meanwhile, industrial demand is absolutely exploding because of the push for solar panels, electric vehicles, and advanced electronics.
All of which require highly conductive physical silver.
Every single one of them.
And if stagnant byproduct mining wasn't enough of a structural problem, we have to talk about this massive curveball out of China. Because starting next month, in May 2026, China is placing full export restrictions on sulfuric acid to prioritize their domestic needs.
This is a huge deal.
Now, I never thought I'd care about the global trade of sulfuric acid, but this seems to be the linchpin.
It really is. Sulfuric acid is like the silent workhorse of global industry. When you mine that copper ore, which, remember, contains your byproduct silver, you have to extract the metals from the raw rock.
Right.
Sulfuric acid is the primary chemical agent used in leaching and refining those metals at a massive industrial scale.
But surely there are other chemicals, right?
Right.
Why is a Chinese export ban on this specific acid such a catastrophic bottleneck? Can't refineries just pivot to something else?
Not at this scale, no. Refineries are highly calibrated, multi-billion-dollar facilities built entirely around the specific chemistry and cheap availability of sulfuric acid. Yeah, you can't just swap in a different chemical without completely re-engineering the physical plant and ruining your profit margins. And China dominates the export of this chemical. When they cut off the supply, regions dependent on their exports simply can't process their raw ore.
Here's where it gets really interesting. Let me make sure I'm picturing this domino effect correctly. So you're telling me that a domestic chemical export ban in China could ultimately bottleneck the creation of solar panels and tech globally simply because we can't refine the silver.
Yes.
Talk about a terrifying domino effect.
Yeah.
Even if we have the political will to build the green transition, we physically can't get the silver.
That is the exact structural reality the paper markets are ignoring. Without sulfuric acid, regions dependent on Chinese supplies will see their deficits intensify rapidly. The physical capacity to refine the metal is tightening like a vice.
Yet if you look at a trading screen right now, paper silver is still trading calmly at $75 to $80 an ounce.
Completely detached from the physical bottleneck.
Okay, so we have a geopolitical crisis choking global energy, paper markets absorbing the financial shock by draining physical inventories, and an irreplaceable chemical vanishing from the silver supply chain.
The powder keg.
The natural question for anyone listening is, have we ever seen this specific mechanical setup before? Like, what happens when the physical shortage finally forces the paper market to wake up?
The historical data actually provides a very clear roadmap to this. If you look back at the 1979 Iranian Revolution and the 2011 Libyan conflict, both were massive geopolitical energy crises that disrupted global logistics.
Right.
And in both of those cases, the immediate reaction of precious metals was identical to what we are seeing today, a complete lag.
So the prices just stayed flat while the world panicked?
They stayed flat because the mechanics worked exactly as they are working now. The paper derivatives absorbed the initial shock. Traders sold off paper assets to raise cash.
Just like the liquidity drains you mentioned earlier.
Exactly. And to satisfy the underlying demand, physical inventories were quietly drained to mask the shortage. But that mechanism only works until the global inventory buffers are completely depleted.
What actually happens on the day the shock absorber finally snaps? Walk us through that mechanically.
Well, it happens when a commercial entity, say a major solar panel manufacturer, goes to the exchange holding a paper contract and says, I don't want to roll this over for a cash settlement. I need the actual physical silver delivered to my factory today.
And what if the exchange doesn't have it?
When the exchange realizes the physical inventory has been drained and they cannot easily fulfill that physical delivery, panic sets in. The paper illusion breaks.
Right.
In 1979 and 2011, once the market realized the physical buffers were gone and the supply shock was permanent, prices didn't just drift higher. They surged violently upward to force demand destruction.
And the pressure cooker is only getting hotter right now because the Hormuz blockade is already cascading into other vital areas. It's causing delays in tech sectors due to impacts on helium for semiconductors, and it's straining rare earth processing.
It's touching everything.
Plus, governments worldwide are aggressively doing deficit spending, which historically correlates with currency debasement. So I want to ask you directly, for the listener who wants to track this. If history rhymes, what are the actual alarm bells you should be listening for right now? When does that shock absorber finally break?
You have to look past the spot price and monitor the market signal indicators for physical movement. First, track central bank gold purchases.
Okay.
If you see those massive over-the-counter accumulations accelerating further, it indicates sovereigns are losing faith in the fiat currency system and rushing to secure hard assets. Second, you have to watch shifts in the COMEX eligible inventories.
Let's clarify that. COMEX is the primary futures and options exchange. Yeah. What is the difference between their eligible inventory and everything else?
This is a crucial distinction. The COMEX vaults hold two types of metal:
Right.
registered and eligible.
Okay.
Registered metal is actively available to settle paper contracts. Eligible metal is physical metal sitting in the vault that meets the purity standards, but it is privately owned and not currently available to the market.
I see.
If you start seeing massive drops in eligible inventory, it means private owners are demanding their physical metal be removed from the financial system entirely to satisfy real-world industrial demand.
Because they don't trust the exchange to hold it anymore. What else should we watch?
Monitor the physical delivery volumes themselves from the exchanges. Are traders suddenly standing for delivery instead of settling for cash? And finally, track the Shanghai futures premiums.
Why Shanghai specifically? How does that exchange operate differently than London or New York?
The Shanghai Gold Exchange is fundamentally a physical market, whereas Western exchanges are dominated by paper futures.
Yep.
In Asia, cultural and economic practices drive a much higher demand for actual physical metal.
Okay, that makes sense.
When physical supply gets tight globally, you will often see the price of gold or silver in Shanghai trade at a significant premium, meaning a higher price compared to the West. If that Shanghai premium spikes aggressively, it is a glaring early warning sign that physical scarcity is overwhelming the paper price suppression.
Let's bring all of this together. The core takeaway for you today is recognizing the massive factual disconnect happening right under our noses.
Absolutely.
On one side of the ledger, you have robust physical realities. A geopolitical blockade in the Strait of Hormuz choking energy, an exploding industrial demand for conductive metals, stagnant byproduct mining, and a Chinese chemical ban threatening the refining process.
It's a perfect storm.
And on the other side, you have the short-term suppressors. Institutional margin calls, algorithms trading on immediate tech earnings, and paper markets quietly draining physical inventories to maintain the illusion of price stability. Systemic pressure is building across energy, industry, and finance.
It is a profound structural imbalance. And as we wrap up, we must remind you that this deep dive explored factual market observations and historical mechanics purely for educational purposes.
Yes, very important.
We are analyzing supply and demand forces. This discussion does not constitute financial, investment, or trading advice. Always consult qualified professionals before making any personal financial decisions.
If you want to dig into the raw data and look at these mechanics yourself, you can find the factual resource we analyzed today at the Gold IRA Companies Bulletin. Doug Young's full report is available at goldiracompaniescompared.com.
Highly recommend reading it.
That is goldiracompaniescompared.com. We've also dropped a direct link right in the episode notes, the deep dive notes, for you to check out.
Taking the time to understand these underlying physical supply chains is essential in an economy that is rapidly shifting from paper abundance to physical scarcity.
Which leads us to a final thought to leave you with. We've spent our time detailing how financial derivatives and paper markets are currently masking a severe physical shortage of critical materials like silver.
Right.
But let's project that forward to the massive global transition we are attempting toward green energy. Millions of solar panels, electric vehicle fleets, modernizing the entire grid, all of it relies entirely on the physical availability of these exact metals.
So the question to mull over becomes, what happens to our rapid global transition to green energy when physical reality finally shatters the paper illusion?
Wow.
Will the green revolution ultimately be stalled not by a lack of technological innovation or political will, but by basic, unavoidable accounting? What happens when there simply isn't enough physical silver above ground to build the future we've promised ourselves?
It is a heavy, incredibly important question to explore on your own, especially when the financial surface of the water still looks so calm. We want to warmly thank you for joining us on this deep dive. Keep questioning the surface level, keep tracking the undertow, and we will catch you on the next one.